Hello there. Welcome back to part 2 of the Black Market panel discussion by Piranha Profits. So for those of you who have yet to catch part 1 yet, I highly encourage you to do so first, as you get to have a deeper understanding of the different mentors' investing and even trading style. So in part 1, we have also previously talked about the broad trends in the general markets, and more importantly, explore how do we currently trade and invest in the current AI bubble narrative. So today, joining us are our 7 to 8 figure mentors at Piranha and Adam, Elson and Bang, whom have all built their wealth through different investing and trading strategies with their own unique edge. And my job here today is, of course, to tap onto their wealth of wisdom and to share more with you guys. So in the first part of this discussion, I want to answer a $1 trillion question, like literally. I think over the last 3 to 4 years, we have seen this group of stocks called the Magnificent Seven. They've posted great amount of returns, tremendous growth in their earnings, and close to none kind of business model. And these 7 companies actually include Apple, Nvidia, Microsoft, Amazon, Tesla, Alphabet, and Meta. And of course, the question in most investors and traders' minds today is whether this group of stocks can still go up from here. So we have seen that just these 7 names alone currently account for a third of the S&P 500 weightage. And they accounted for 42% of the index's 14.8% total returns in the first 3 quarters of 2025, with Nvidia leading the pack. So for newer investors, it might seem like the Mag 7 current dominance is a 2025 story. But fortunately or unfortunately, it's not. Actually, according to the recent Guide to the Markets from JPM, it shows that these 7 companies has consistently driven a major share of the returns over the past decade or so. And just recently, a fun fact, Broadcom has actually overtaken Tesla's market cap. And right now, Tesla is actually ranked 8, so I'm not too sure if there is a new Mag 7 name where Broadcom will replace Tesla. And with that aside, I think a very important question amongst most investors' mind today. Let's ask the investor first for Adam. A lot of all these companies had a phenomenal run. They are currently at a very high price. Can they still keep going up? And can we continue to make profits as investors for this group of Mag 7 names?
The simple answer is yes, for a few reasons. Number one, when people say that it's a high price, what do you mean by high price? Because you may say, oh, high price based on the price has gone up so much, right? But let me give you an example, right? So Apple was listed in 1980. And when Warren Buffett bought Apple in 2016, 36 years after the IPO, Apple's share price already went up 300-fold. Now, people say, hey, the price already went up 300-fold. How much higher can you go, right? But since Buffett bought it, it went up another 10-fold, almost 10-fold. And he has made $150 billion in profits. And that profit made in Apple is more than any other stock he has ever owned. So the whole point about investing is you don't care about how much the stock already went up. Whether the stock went up 300 times, 500 times, 1,000, it doesn't matter. What matters is where it will go in the future. And where it will go in the future depends on will the earnings continue to grow, all right? Now, if you look at many of these companies in the Magnificent Seven, again, not all of them, but if you look at many of them, you find that there are companies where everyone in the world uses their products. For example, look at Meta Platforms that owns WhatsApp, Instagram, and Facebook, right? Their monthly active users is 3.8 billion users. 3.8 billion. That's half the world's population uses one of their apps, And like in Asia, we can't live without WhatsApp. Everyone uses WhatsApp, right? You can't live without Instagram or Facebook, especially as a company, right? Almost everyone in the world uses Google, whether Google Map, Google Search, Google Doc, Gmail, or you watch YouTube, right? So these are companies where everyone has to use it who uses it, okay? And the question you could ask is that 5-10 years from now, will people continue using it? The answer is yes, because there's no other close alternative. Now, in the old days, people used to say that if you buy these big companies, it's very hard to make money because everyone knows everything about them. There's no edge. And the way to make money is to buy the small companies that no one knows about, the hidden gems, right? The small caps. Now, before 2020 pandemic, in fact, the small cap index, the Russell 2000, has always outperformed the S&P 500 before 2020. But after 2020, everything changed Because in 2020, during the pandemic, the small companies who didn't have the cash to sustain and they have a lot of debt, they got hit by the pandemic. Whereas the big companies that have a lot of cash were hardly affected. Then in 2022, when the Fed raised interest rates, the small companies also got affected because they are the most sensitive to high interest rates. Whereas the big companies are not sensitive to interest rates. So we are now in a new environment where it's the big companies that are now outperforming the small companies. And you continue to do so because, think about it, these big companies are spending billions and billions on infrastructure, on AI. Can their competitors afford to do that? Can new startups do that? It is become impossible. Like, Meta spends billions of dollars. Can Snapchat spend billions of dollars and not go bust? They can't. So you notice that in this world, it is a winner take all now. The winner takes everything. Okay? And the strong becomes even stronger. Now, I'm not saying it's good or bad. I'm saying that's a reality of the market. So unless you own the strongest in the market now, the winner takes all, it's very hard to make money. That's why I keep emphasizing you only own the strongest companies because they will continue to become stronger and stronger in the future.
I think one important thing that people tend to also forget when you look at this group of stocks, saying that they make up X percentage of the returns, X percentage of the index, usually when you look at the profits attributable to these set of companies, they tend to also weigh very strongly, meaning let's say they contribute 80% of the index returns, but they also do 80% of the earnings growth. So that's generally how you look at the relationship.
So people are now concerned, they're saying that, oh, there's a concentration risk, all the money is coming from these few companies. It's nothing new. By the way, if you look at the recent research, you can show the chart, since 1926, if I'm not wrong, to now, 100% of the wealth in the market is generated by only 3% of the companies. 3% of the companies generate all the wealth in the market, which means 97% of stocks in the market either don't generate wealth or they destroy your wealth. And 90% of all the profits come from 1.88% of all the companies. And 50% of all the profits come from 0.25% of all the companies. Right? It has always been like that. People just don't realize it. And that's why I keep emphasizing in my investing class with my students, only invest in the top less than 1% of companies. Because the 99%, short term, the price can go up, of course. But long run, they will not sustain. They will eventually collapse. But it's the less than 1%, they will go up and stay there for decades. And you only want to own these. And again, in my webinar, I'll share with you what are the criteria to finding and identifying these companies because they've got certain similar characteristics. So if you want to register for my webinar to learn how I find these companies, click and register in the link below.
So maybe just to also ground us into some numbers, right? I just extracted from Yardeni himself, the research platform, and to just do a very quick comparison amongst the group of Max 7 names versus the rest of the S&P 500. And here are some of the figures. So when comparing the forward earnings growth of these Max 7 companies, they are looking at roughly 17.6%, while the other 493 is at 12.4%. So you can see that's an additional 50% in terms of forward earnings growth. In terms of forward margin, Max 7 is at 27%, S&P 493 is at 12%. So that's more than double in terms of the quality of the earnings that is represented in the margins itself. So the forward PE for Max 7, I think likewise it has been a very big commotion. So yes, they are at a forward PE of 30, while the other 493 is at 20 times, give or take, while the general S&P 500 is at 22.8 times. So you can see the difference there. S&P 493, 20, S&P 500, 23, and Max 7 at 30 times. But it is kind of justifiably so due to the quality of the earnings and the expected growth rate ahead. So the fortunate or unfortunate thing, actually, if you were to break down the Max 7, only one of them looks particularly skewed, pulling up the general numbers. So I think just wanted to get Adam, your view on this current breakdown.
Yeah, so like I've always taught in my videos and my courses that PE ratio is meaningless unless you compare it to the earnings growth rate, right? So let's say company A has a PE ratio of 5. May look cheap, but what if I told you the earnings is not growing? Then 5 PE is expensive, right? But company B may have a PE ratio of 30, but the earnings are growing at 30%, then company B is cheaper than company A. So a good example is NVIDIA. So I first bought NVIDIA in October 2022. And at that time, their PE ratio was, I think, about 35 to 40 times earnings. And people say, oh, it's so expensive, right? Intel cheaper, Intel's only 10 times earnings, and other companies, it's much lower, right? But since I bought NVIDIA at $15 at the time, now NVIDIA is at $190, right? So it's gone up more than 10 times I paid for it, right? But you know what's the joke? Today, NVIDIA's forward PE ratio is about 26 times. That means NVIDIA, in the last 3 years, the share price went up 11 times. But it is cheaper today than 3 years ago because the PE has dropped, because the earnings has grown faster than the price. So you cannot just look at PE, is very, very misleading, right? So the question you could ask yourself is, in the future, will these companies make more money in the next 3, 5, 10 years? And the answer, I think, is yes. Why? Because over time, they've got pricing power. They can keep on raising prices above inflation, and they have become utility businesses, right? It's like Apple, people who are Apple users, which is not the whole world, but I think it's like 1/3 of the world population uses Apple. Once you're in the Apple ecosystem, you have to keep using Apple products, right? If not, it becomes very inconvenient, like for myself, right? Same thing, people who use Google, who watch YouTube, and Amazon. Now, you guys know that in the last few weeks, there was an outage with Amazon Web Services, right? And after the outage, Amazon's stock price went up. You say, how come? Their system was down, why did the stock price go up? Because people realized how important they were. That, if I'm not wrong, maybe half of the world's websites are run on AWS. And they realize, without AWS, half the world's going to die. So there's very high switching costs. I think about it. The entire Netflix business is built on AWS. And Netflix cannot happily migrate to another cloud provider, right? So there's a lot of stickiness in it. So because these have become like monopoly, we call it consumer monopolies, and there's no close alternative, they'll continue to dominate for decades and decades.
Okay, thanks, Adam. So now I think moving on to Elson. So Elson, I know in part 1, you have talked about your trade with Tesla and you have backed a very nice 6-figure profits. So, and Tesla is also part of this Max 7 names. So maybe you want to share a little bit more in terms of your Tesla trade. What were you looking at and how did that trade setup come to you?
Okay, for Tesla, I will name it as, I'll call it one of my highest high conviction trade. So when I trade, I actually look at, just like Stanley Druckenmiller, he actually said in one of the interview before that, if he found a stock that has a fundamental tailwind, he will not buy unless the technicals also align. So similar to me as well, right? I was watching Tesla stock for the last few years, and it was only during earlier this year in April, that I saw a technical pattern, right? And it aligns with my fundamental belief in the company as well, right? And I took the trade, and it's considered one of my highest conviction trade. In terms of fundamentals, Tesla actually, to me, covers the top drivers in the economy in the next few years. For example, in terms of AI, they are into full self-driving, right? Robo-taxi expansion as well. They are now expanding in the US, and I believe in many parts of the world in the next few years as well. And in terms of energy, right, they are also advancing in terms of their Megapack energy business. And also in the AI hyperscaler data centers, right, a lot of them are also using Tesla Megapack energy. And also in terms of autonomy, in the next couple of years, I believe we all know that robotics is going to be a very important theme in the market, driving higher margins for a lot of companies. So Tesla has been working on humanoid robots for the last few years. And at the start, I think Boston Robotics is one of the top companies in the sector. And right now, I believe Tesla is exceeding, right, companies like Boston Robotics. Because of their lead in engineering, right, they are able to manufacture these humanoid robots at a lower cost and with more efficiency. So I believe that eventually, even though there's a lot of competition, given Tesla high talent base, right, and also engineering capabilities, they would be able to become one of the top players in the humanoid robots business. So in my upcoming Black Market online webinar, I'll be sharing with you guys how I actually spot some of these strong narrative stocks, right, and how I actually enter them using the price action manipulation strategy. And I'll also be sharing with you guys my exclusive crypto watch list for 2026, right, and how I zoom in to some of the key narrative in the crypto market, how I catch 8 to 10 bagger trades in XRP, Ripple Coin, and also recently in Zcash, which is a privacy-focused token, before they run and do the explosive breakouts.
Thanks, Elson. So now moving on to Bang. I think Bang, from our previous discussion last year, I know you are a big fan of the Fab 5. They call it the Fabulous 5 stocks. And technically, it's kind of like a subset of the Max 7. So maybe you can give us an update on your trades around the Fab 5 over the last 12 months. And also, how do you look at structuring your options trades in this group of Max 7 stocks in this current market environment?
All right, so I love trading options on Max 7 stocks for a few reasons. Number one, they are solid mega cap stock, and each of them have a big fan base, being it Apple, Tesla, Nvidia, right? So their stock will not be like easily get like hammer or collapse because the fan base there. Number two, the option premiums on these stocks are very good, right? So as an option sellers, I love to sell options on these stocks. Number three, these stocks, you look at the trend, it's on solid uptrend for a long-term period. Now, last year I preferred the Mac 5, which is excluding Apple and Tesla. So the rest 5 was my favorite because those are the stocks, in my opinion, have good fundamentals, and on the technical standpoint, it was also on the uptrend. And that's why, yes, last year I used the DS Hammer option strategy, which is more bullish strategy because these stocks have very solid bullish setup. So I prefer to use the DS Hammer last year. Now this year, many of them have run up quite a bit. So, and some of them may be overvalued by now. So I prefer to use more conservative strategy called C2D, which is starting with a calendar spread, where if the stock price pulls back, it has some good protection on the downside, right? So some of the stocks, if you notice recently, released earnings. Their earnings are very good, but the stock price declined, like Meta, like Microsoft. So those are the ones that I am putting on the watch list right now. Very good entry point. In my opinion, based on the current setup, stock price will take some time to consolidate and sideways and eventually rally again. So that is a perfect entry point for C2D strategy. So in the upcoming webinar, I will share a lot of details on this C2D strategy. And in my live trade hunt webinar, I hope by that time, those stocks that I mentioned would still have very attractive entry points where I could use my real money to trade as well. So that's continue to be my favorite stocks to trade.
Maybe in particular, is there anything specifically that you love one over the rest out of these names today?
Okay, some of the stocks like Meta and Microsoft with the recent decline after the earnings, I think they're getting more attractive again, right? No longer like overvalue. Nvidia, despite the fact that it is near on-time high, it is still reasonably valued right now. So in my opinion, I have a very strong conviction on those names, and eventually they will be back to on-time highs again, and that will be a good setup for C2D strategy trade that I'm talking about. So beyond the Max 7, one of my mega cap stock that I also love to trade on is Netflix. I myself a big fan of Netflix. I watch Netflix almost every day, even when I sign off from trading. It's late in the night, but most of the time I will finish one more episode of one of the movies before I go to bed, right? So one of my favorite stocks, and the stock also have very good premiums to trade, and this could be another potential candidate to trade using the C2D strategy as well.
So now with this conversation about Max 7 aside, I think the second topic that we want to tackle in part 2 of the panel discussion is really this idea around market fragility. So if you think about it, I think beneath the current headline strength that we see, where assets across the globe have all rallied pretty significantly, the market breadth itself, it's kind of concentrated and it remains narrow in some of these particular names that we see here. And volatility also spikes very quickly on a lot of your so-called macro or even policy-related risks, especially with the chief manipulator in the White House today. So the markets also do feel a little bit more sensitive to headlines, especially in the current environment of this whole AI bubble narrative, that many investors are starting to feel conditioned to just buy the dip and assuming that every drop will just bounce back, and those kind of mindset might potentially also breed some level of complacency. So I think one such flashpoint that we've seen over the last 1 month or so was particularly in the crypto markets, where we saw the largest crypto liquidation of all time, where nearly $9 billion was wiped out in the 24-hour period. So to give us a little bit more context and understanding of that episode, Elson, can you share a little bit more with the audience of what happened 1 month ago?
So basically on 10th of October, before the major liquidation in crypto happens, right, it actually started by Donald Trump actually tweeted that he's going to impose 100% tariff on China in response to China export control on the rare earth minerals, which is a crucial mineral for many advanced industries like AI, right? Even like building your EV cars or even an iPhone, right? It's used in many of the defense industries as well. So I believe that Donald Trump wants to actually send a strong message to China, and he actually announced this 100% tariff after the market closed, right, on a Friday night. So basically, market is not trading the next day, and as we all know that post-market, after the regular session close, liquidity is at its lowest, right? So after Donald Trump actually announced the 100% tariff, there was a major liquidation in the crypto markets. And actually, such major liquidation did not just happen in crypto markets before, but happened in 2010. There was in the US there was this major flash crash, where I believe some of the major companies have for a period of 30 minutes, right, they actually dropped more than 80-90% of their share price, right? So for crypto, right, on 10th of October, the liquidation event actually cost $19 billion of losses. Okay, and this is even bigger than back in 2021, 2020, right? The Terra Luna crisis, right? Where the liquidation event actually cost $2 billion of losses. So this impact is actually 10 times more. And how I actually see this develop is that prior to this liquidation event, right? There was a lot of hype around perpetual exchanges in crypto. Right, it started with Hyperliquid, and then which is a decentralized perpetual futures exchange where you can actually trade with leverage. Right, you put in, let's say $1,000, you can trade up to 10 times, 20 times, 30 times, or even 50 times your money. Right, and it's very popular with a lot of speculators, crypto traders. Okay, and they were actually offering this thing called airdrops in crypto. It means like if you generate volume, is like you spend more or you do more of the activities in the exchange, you collect points, right, and you get free tokens that you can sell for profits. And other competitors like Binance, right, which is a centralized exchange, I believe they feel the competition from Hyperliquid because I think volumes are shifting over to Hyperliquid because of their platform is much easier to use, right, and many people say that it's very user-friendly as well. So Binance actually also launched during a time, right, their perpetual futures exchange called Aster, right? And they're also offering incentive for traders to trade on the exchange. And there are many other competitors that come in, like Avantis, that is being launched by Coinbase, a Base network. So during that period of time prior to the liquidation, a lot of crypto traders are basically moving from the centralized exchange onto the decentralized perpetual futures exchange to trade and to farm for the airdrop, right? They may not be doing genuine trading but they are actually farming airdrop. For example, farming airdrop and also doing this thing called the basis trade, which is to farm for yield. Like for example, what they do in the basis trade is to buy the spot and to short the futures, right? So to profit from the yield, overnight interest on the yield, right? And this actually caused a lot of leverage in the system to build up, right? Because some people actually, they are using, let's say, a small amount of money to actually generate high volume, churning the volumes. And I believe prior to the liquidation event, right, there are some major players out there, whales in the market, actually, they may have seen that the leverage is building up in the crypto perpetual exchanges. And it's just a matter of time, right, that they chase this liquidation. I mean, from a big boy's perspective as a market maker, right, if I were to spend $100 million, but I can liquidate $1 billion, I would do that. Because the risk reward is 1:10. And market makers and big boys, they are also like a trader, right? They will market make for profits. And they will chase for stop loss, chase liquidation for profits as well. And my take of the situation on 10th of October is that the market makers and the whales, right, in crypto were just waiting for an excuse, a panic, a story, right, to drive down prices. And that was what happened, right? There was major liquidation across different exchanges, especially in Binance as well, right? There was even stories of people, they couldn't even close their position even though they got stop loss. I would say it got to do with stock price coming down and also lack of access and certain manipulation in the market, okay? And this has caused, I think, large losses in the crypto market.
And we've even saw on social media, right, where there were unfortunate events. So from this particular market crash event on October 10th, maybe what are certain lessons that you took away or distilled from this event?
Actually, this kind of liquidation event happened day in, day out in the markets, right? I've seen it every day happening in the markets. It's not something new, right? Market makers chase stop losses, right, and chase liquidation levels every now and then in the markets for manipulation to take place. So the best we can do, right, in the market, for example, in the stock market, is to really put a stop loss. So in the markets, chasing liquidity or trading stop loss, like for example, if you're a long market maker, push down the price to trigger your sell orders to get you out, is something very common in the stock market and even in the crypto market, right? In trading, we definitely have to put a stop loss, right? But I would say that the risk of a flash crash happening again is lower in the stock market because after the 2010 flash crash, the SEC in the US, right, has actually implemented a lot of circuit breakers to prevent such incident from happening again. However, in the crypto market, it's a bit more cowboy, right? And so for the crypto markets, right, I actually stay away from leverage, right? So I don't really trade on the perpetual exchanges. I just go buy spot. Spot means that I just use whatever available funds I have, right? If I got $10,000, I'll just buy $10,000 worth of that particular crypto. I will not leverage because I'm in the crypto market, like I said, anytime certain market makers or big boys can do that liquidation event again.
So if you buy crypto with your cash, 100%,
Yeah.
then market maker cannot liquidate your position.
Yes.
Right? I think it's...
So in fact, that's what happened to me on the 10th of October, right? All my positions are in spot. So I went to sleep that night, right? Then the next morning when I wake up, actually everything goes back to the same price, but I saw a big spike in some of the odds. Yeah.
Maybe Alson, can I also get your baseline view of the crypto markets today? Because it seems like there is some sort of a K-shaped recovery. So the big market cap, they're all still chugging along pretty well. While I've seen a lot of all these alternative coins, assets that all went down pretty significantly. So how does, let's say, a trader now in the crypto market, how does he make sense of this situation?
I think we need to be very selective in the crypto market, right? Actually, my long-term view in the crypto market in the next few years is that the big cap cryptos, right, is likely to survive for multi-cycles, just like Bitcoin, Ethereum, XRP. These are some of the big caps crypto. A lot of the altcoins is likely will not survive, right? Because a lot of them are really just what we call utility tokens. They may not have a very strong use case. And most of the money that come into crypto are now going to institutional asset class cryptos like Bitcoin, right? Ethereum, right? So very little money is actually pouring into altcoins. And actually every month, right, there are billions of dollars of unlocks in the crypto market. So for the crypto market to really have an alt season to go up strongly, right, a lot of retail money has to come in. Institutional and retail money has to come into the market to push up the market. And as I mentioned before, in today's crypto market, there's 19,000 over alt tokens as compared to 2016 when I started, there's 2,000. So you need a lot of money to push alt tokens. So you need to be very selective. I think whenever there is a certain narrative in the crypto market, certain alts may still run, but you need to be selective. And how I actually look out for entry in the altcoins is that I use my bullish PAM price action manipulation strategy to get into the alts. Sometimes there is a setup in the crypto, right, that there is a technical setup. It actually tells me that to read up more about the alts. It's like the wisdom of the crowd is telling me that there's something going on for the alts, right? And sometimes my ideas, right, in cryptocurrency actually come from the chart first. The chart actually has a pattern first, then I read up more into it, and sometimes I find some gems out of through the technicals as well.
Thanks, Elson, for sharing and to really give us a lot more insights in the crypto market. So on this topic still about market fragility, I think I now want to cast our attention to something, a movement of some sort in the recent options market, where we've seen this kind of strategy called zero DTE trading or 0 day to expiry options trading. So Bang, just wanted to get your thoughts. Do you think this increase in activity for 0 DTE is also part of accumulating to this whole very fragile market environment?
Yeah, so 0 DTE trading is not something totally new. It's been there for a few years now. But to be honest, I have not traded it before until recently. So I keep hearing about different kinds of trading on 0 DTE, and I did some study on YouTube on how people construct their trades. And then I told myself that the only way for me to know if this is working, is that worth my effort or lifestyle, is it suitable to my lifestyle or not, is to put my real money in the test. So I did the real test using $100,000 capital. And I spent about 2 months trading different types of trade using 0 DTE on SPX, which is a S&P 500 index. And I experiment different strategies, naked call, naked put, strangle, straddles, iron condor, iron butterfly, defy risk kind of thing. So I traded all kinds of different strategies that I know. So what I can say is that yes, in this kinds of trade, you could make money most of the time, right? Most of the time, in a normal day, you would typically earn decent money from the trade because there's a low chance that the market will move against the trade. But it just need to take 1 to 2 higher volatility day, where S&P 500 could move a lot, to wipe out all the profits that you accumulated for many weeks, right? On top of that, commission will eat like 5-10% of your profits every single day as well. So the thing that I find challenging for me is the time that I need to spend on the trade. It's quite taxing. It's quite like stressful because I need to watch my trade constantly. And at the end of the day, after 2 months, I concluded that, hey, it's not worth my while, and maybe it's not like even suitable to my lifestyle, because I don't like the trade where I have to look at my trade constantly on like a hawk, right? And then eventually it's very stressful, and I don't have a clear mind for other trades. So at the end, I decided to stop. So I have tested it, making some money, but it's not worth my effort. And importantly in trading, because I have a bigger position in other strategies and accounts, I need to make sure that I have a clear mind I have enough, thinking for other trades than, being tied up with these zero DTE trades. So now, with regards to the zero DTE, the trade itself expires within a day, right? So you enter the trade and you need to exit it within a day because the option will expire on the same day. So that's why it's called zero DTE, zero date to expiration. Now, it makes it so difficult if the market moves against the trade because you have no time to repair the trade. So I shared earlier in the first part, right? During the Liberation Day, the market collapsed, but then many of my trades still have long time to expiration. So it has a time to recover, right? Many of them turn around eventually. But in zero DTE trades, you have no time for the repair, right? Because the option will expire in the same day. So you have to hit the big loss and you need to realize the loss during the day. That's why I say you should hit 1 to 2 days of high volatility movement to wipe out on the profit you make for the whole month, right? So it's not worth my while. So it's not like something really bad, but it's not my thing.
In fact, this, I think, one thing that three of us have in common. When Alson first started, he actually started as a day trader, which means you buy and sell on the same day. When I started years ago, I also started as a day trader, and zero DTE is basically day trading. And none of us now do day trading because we realize that it's not worth the time, it's not worth the effort. We make so much more money now with less stress by taking longer duration positions.
Right. Adam, have you tried or dabbled in this zero DTE
Yeah,
strategy?
actually, when Bang was actually experimenting, I also experimented with him and found the same thing. So there are many days I made money, and one day it all got wiped out, and I said, it's wasting my time. So in the end, I also stopped doing that.
Right, okay. Thanks Adam and Bang for sharing. So I think also on this topic about market fragility, it was quite interesting because as I was preparing for this black market panel discussion, I was consulting or interviewing some of our colleagues at Piranha, and they are also traders and investors likewise. And I think one of the concerns that actually popped up that I thought was a very interesting question that I want to pose to Bang as well, is that I think given this current market climate, we know that Trump administration has been very volatile in his comments. One day he's best friends with China's presidency, the next day he's saying that he's implementing a 100% tariff. And because of this kind of huge volatility spikes, it sometimes disrupts the trading pattern or routine. Maybe I was long, my position is a long position, it was in a green, and then Trump says something and then it goes into the red. So I just wanted to consult you, like for yourself, how are you handling this sort of volatility that you can't control?
Yeah, first of all, we have to accept that Trump posting on his social media is something that no one can predict, right? It's an unknowable event. And it's part of the trading uncertainty that you always have to face. So I will accept that this is the risk that we have to face as a trader. And as the same experience I got during the Liberation Day, yes, we have a drawdown, but hey, it's part of the trading plan, right? In trading, you can never have 100% win rate all the time. There will be time when you have drawdown, but over the long run, if you continue to use statistically proven success model or strategy, you will win in the long term, and you will make all the money back to offset the gain, the loss that you experienced before. And it happened to me many times. Every time I have drawdown, setbacks, I always come back with a much stronger gain, and over the long run, I produce a very good return. And that is more important than short-term volatility. So we cannot predict what is unpredictable, and don't focus on what we cannot control.
Do you have any tips to handle this kind of volatility as a trader now watching this?
Actually, volatility create more premiums, right? So I'm option traders here. So high volatility will create more, option premium for me to collect. And the strategies that I'm going to share, the C2D, is a perfect strategy to use to benefit from high volatility option premium, because most of the time I'm paid to wait, right? So And then higher volatility brings more premium for me to collect.
Right. Okay, thanks Bang for sharing. So I think maybe a last part about this market fragility topic. Adam, I just wanted to ask you, do you think complacency is creeping in? Because we are seeing a lot of investors, traders alike, just piling into the market, buying the dips, and thinking that the market will bail them out. Because whatever dips you buy, the market will just end up higher. What's your thoughts on this? Do you think the market is complacent?
Not at all. And the reason I said it is because I'm old enough to remember the dot-com bubble. And the situation now is so different from the dot-com bubble. Because in the dot-com bubble, I recall that every day, the stock price would just go up. 20% a day, it just went up. And no matter what the news, what happened, it just went up. And many of the stocks that went up in the dot-com bubble, they had no profits. In fact, some of them had no sales. They just had eyeballs, they just went up. That was really a bubble. You could feel it. Now, it's totally different. Now, even when a company like Microsoft announced good earnings, the price still dropped. Meta announced good earnings, the price still dropped. So in fact, it's nowhere near the bubble, you know? But of course, within the market, there are pockets of bubbles that are formed, but they don't last very long. So a good example is the bubble in the alts coin that Elsa mentioned, that deflated, right? Then we had another bubble in the quantum computing stocks, right? And that dropped like 30%, I think 2 weeks ago. So it's very different, right? So, and like I said, right now, if I look at some of the hyperscalers, now, not too long ago, in fact, just a few months ago, Google was still very cheap. Amazon was still very cheap. Now, they're not cheap anymore, but they're also not in a bubble. They are, I'll say, fairly priced or slightly above intrinsic value, okay? Meta recently came down. I think Meta is now attractive. So, nowhere near the bubble territory. And like I said, many of the stocks that are not AI related have been disregarded by the market because they're not sexy, and some of them are actually very, very undervalued. All right, some of the healthcare stocks, industrial stocks, consumer staple stocks are undervalued. So, like I keep saying, there is opportunity. So ignore the narrative the media is giving you and do your own research. Right, and that's what I'll be showing you in my webinar on how I do research to find quality companies that are undervalued, even in this market.
So I think with all the current discussions, looking out ahead into end 2025 and potentially moving into 2026, I think investors and traders alike are more concerned about what should they do? What opportunities do you guys see? So Adam, maybe to get the ball rolling, personally for yourself, how are you going to position in the upcoming, say, 1 to 2 quarters for your own portfolio? Anything special or different that you're doing? Or any tips or things that you can share with the audience today?
So like I mentioned earlier on, based on the current market trend and based on the fundamental tailwinds, like again, the deregulation of the Trump administration, the tax cuts, the Fed continue to ease and to start QE again, the market looks to be bullish. And of course, November, December are the seasonally bullish periods of the year, right? So barring any unforeseen event that no one can predict, the market should continue to go higher. Now, what am I doing in my investment portfolio is always the same thing, which is I keep adding to high quality companies as long as I don't yet have a full position. And like I said, right now, I think there are still a lot of good companies that are still undervalued that I'm slowly adding to. Next year, again, barring any unforeseen Trump tweets, market should continue higher next year as well, because next year is again the 4th year of the bull market. And like I said, the average bull market lasts at least 5 to 6 years. And again, you've got the AI revolution. We're still at the early stages with agentic AI and robotics and all that's coming to play.
Maybe can I also ask a little bit in terms of, let's say, the cash allocation of your portfolio? Yeah. Is it increasing? Are you doing anything special? And when you talk about like the speed of deployment, are you intentionally trying to slow down the speed because as markets go up?
No,
or do you
I never intentionally want to buy more aggressively or buy less based on predicting where the markets are going. That's not how I've done it. That's not how I always do it. All right. My rules are very simple. For every great company that I have done research, I calculate the intrinsic value. And this is something that all my subscribers are able to see, right? And below the intrinsic value, I've got 4 support levels that I would add shares. So I'm very mechanical. The moment the share price drops below the intrinsic value, hits a support level, I will add shares slowly. I'll buy in 3, 4 to 5 tranches, regardless of the prediction. So I'm very mechanical, I'm very unemotional, and I continue doing that. So what happens is at the start of every year, I've got a certain amount of cash that I budget to invest, which is a certain percentage of my income. All right. So this year, I've already bought 80% of what I plan to buy. So I've only got about 20% left to deploy for the next 2 months. All right. Then next year, which is a new year, then I've got another cash set aside, plan to invest. So again, the whole idea is what we call dollar cost averaging. Every year, keep on spending less than you earn and put the extra into the market in companies that are undervalued, slowly building your positions.
Thanks, Adam, for sharing. So moving on to Bang, anything special? What's your game plan or the opportunities you see in 2026?
Yeah, so I like what Adam said, and I agree with him in terms of the outlook, right? So the trend is up, and trend is your friend until the end, and I don't see it ending, at least for now. We're heading into the last few months of the year, which typically are seasonally positive period of time as well. And again, many people ask me, why don't you put up some of the hedging trade or bearish trades just in case the market pulls back? Why you put up, most of the time you have like calendar, diagonal, bullish, neutral trades. Well, I goes with the probability, right? Forecast, it's just for fun, right? I goes with the probability that the market goes up 2/3 of the time. So why do I want to go against the market? You set up yourself for a failure there. So I just go with the trend in the market, right? So for me, again, some of the stocks that I mentioned that now pulling back, like Meta, like Microsoft, after very good earnings, and now they are consolidating, and that will be very attractive entry points for some of my big trades going forward. I don't mind trading some of the highly speculative stocks like, quantum stock, like uranium or new energy, some stock like Bitcoin or Ethereum, but the treasury companies, like AI, highly speculative, like CoreWeave and stuff like that. I don't mind, because those are the ones that have very juicy premiums to earn, right? And I always use defined risk trades where I know exactly how much is my max loss, the worst case scenario. Even the whole thing collapses to 0, right? So I prefer those trades, and because the premiums are so good, even when the price drops slightly or more, I could still be profitable, right, in this kinds of trade. And of course, when the market goes sideways or up, it's in the trade favor. So I continue to use this C2D in 2026, especially on the Max 7. Now they are also, some of them are now in attractive levels.
Okay. Actually, on this topic I wanted to bring up, and I forgot to ask Adam, was that I think some people might naturally feel uncomfortable. I don't know, it's a very counterintuitive thing. You see your portfolio go all-time high. It's maybe the highest level of net worth, yet you feel uncomfortable and you have that urge to want to take profits. And then Bang was introducing the concept of like hedging, buying put options, selling calls on your positions. I wanted to understand, maybe, I believe you have a story to share in terms of last time when you were hedging and what were the lessons you learned over the years?
Yeah, so in my early career, like most investors, you attempt to hedge, right? Where you think, market's so high, it has to come down. So you hedge your position. How do you hedge? By buying put options, by buying inverse ETFs and stuff like that, right? And once in a while, it works, right? It goes down and it make money, right? But from my experience, I find that out of every 4 times that I hedge or I go against the market, 3 out of 4 times it ends up not making money or even losing money, and only 1 out of 4 times make money. So when I look back at all my hedging over the years, I add it all together, I find that I made very little or hardly made money with all that effort, and it was not worth it, right? It actually pulled down the returns of my entire portfolio. And so at first I thought maybe there's something wrong with me. Maybe I'm not good at shorting. Maybe I'm not good at hedging, right? But then I watched an interview by Stanley Druckenmiller, who is one of the best traders in the world. You know, and he himself admitted that after 40 years of trading, if he added all his short trades together, he also didn't make money. Right? But he said, I still short because it's very fun, even though I know it doesn't make money. So even him, the best trader in the world, can't make money in shorting the market. What makes you think that you can make money? So I realized that is a complete waste of time. And that is the reason why Peter Lynch, Warren Buffett, and all the great investors, they don't bother hedging. They don't bother hedging because they know that more, and this is what Peter Lynch said, he said, more money is lost preparing for corrections, anticipating corrections than the corrections themselves.
Okay, thanks Adam for sharing. I think lastly, of course, we have Elson. Elson, opportunities and game plan for 2026.
So right now, I remain bullish in the Hong Kong market and also the US market because I don't see that in terms of price action, there's no exuberance. For example, like signs of top like flush up bars or the price action getting very steep on the upside. So barring that happening, right, I will remain bullish, which means to say I will stay long in most of my positions. I'll be using my bullish price action manipulation setups to trade the markets. And I'll especially focus on the stronger narrative in the market. Like I think that AI narrative is going to set to continue, right, in the next few years. And I'll be looking out for opportunities in this sector as well. And for crypto, I will be more focused on the bigger caps and also altcoins that have a stronger narrative that aligns with the technicals as well. As I mentioned, I will only consider an entry, right, into alts or even certain stocks, right, unless there is a technical setups. And I rely on my PAM strategies to help me to identify that.
So I hope that all of you have benefited greatly from the mentor's generous sharing. And just to do a quick summary of their own investing and trading style. So for Adam, I think specifically, he has two main portfolios. One focused on capital gains, the second one on generating passive dividend income. And of course, on top of that, he does options trading and even sometimes swing trading to generate additional income on top of that. Bang, on the other hand, he's a pure options trader. He uses options to express his long-term, short-term view. He looks at the markets and he manipulates it very well to his advantage, of course. And lastly, we have Elson, where Elson focuses on swing trading, completely looking at price action only, and to identify manipulation patterns. And I believe there is multiple ways to succeed in the market, and clearly we have 3 living testimonials here. So of course, don't forget to catch us live at the upcoming Black Market event, where you can register for your spot with the link down in the description below, where you'll see each of the mentors divulge their own investing and trading secrets. And also not forgetting that we are going to have a live trade hunt with both Bang and Elson as well. So if you want to end the year on a high note and to start strong in 2026, we'll catch you live at Black Market. This is CK from Piranha Profit signing off. Till next time, keep winning.